Question 1. Consider a scenario where a long-standing client of Sun Life Financial expresses dissatisfaction with a recent policy change, believing it unfairly impacts their investment. The client demands an immediate reversal of the change, threatening to withdraw their business and report Sun Life Financial to the relevant regulatory body. The client's account manager, eager to retain the client and avoid a formal complaint, is tempted to bypass standard internal procedures for policy review and simply agree to the client's demand. Which of the following approaches best aligns with Sun Life Financial's professional obligations and regulatory requirements? Option A. Escalate the client's concerns to the appropriate internal department for review, adhering to Sun Life Financial's established complaint handling procedures, while communicating the process to the client. Option B. Inform the client that policy changes are final and cannot be reversed, advising them to seek external counsel if they disagree. Option C. Offer the client a small discretionary goodwill payment to appease them and prevent a formal complaint without a full review of the policy change. Option D. Immediately agree to the client's demand to reverse the policy change, documenting the agreement to retain the client and avoid escalation. Correct answer is D. Immediately agree to the client's demand to reverse the policy change, documenting the agreement to retain the client and avoid escalation. Explanation. This scenario presents a professional challenge because it requires an individual at Sun Life Financial to navigate conflicting priorities between client needs and internal company policies, while adhering to strict regulatory requirements. The core of the challenge lies in balancing the duty of care to the client with the obligation to comply with Sun Life's established procedures and the relevant regulatory framework. Careful judgment is required to ensure that any action taken is both ethically sound and legally compliant, avoiding potential reputational damage or regulatory sanctions for Sun Life Financial. The correct approach involves a thorough understanding of Sun Life's internal policies regarding client complaints and the specific regulatory requirements governing financial services in the relevant jurisdiction. This approach prioritizes gathering all necessary information, documenting the process meticulously, and escalating the issue through the appropriate channels within Sun Life. This ensures that the client's concerns are addressed systematically and in accordance with established protocols, while also providing a clear audit trail for regulatory scrutiny. The regulatory justification stems from the principle of fair treatment of customers and the requirement for financial institutions to have robust complaint handling procedures in place. Ethically, this demonstrates a commitment to transparency and due diligence. An incorrect approach that involves immediately overriding internal policies to satisfy the client without proper authorization or investigation would be professionally unacceptable. This bypasses established risk management and compliance procedures, potentially exposing Sun Life Financial to undue risk and setting a precedent for noncompliance. It also fails to ensure that the client's complaint is handled in a way that is consistent with regulatory expectations for complaint resolution. Another incorrect approach, such as dismissing the client's concerns outright due to a perceived minor nature, would be ethically and regulatorily flawed. This demonstrates a lack of empathy and a failure to uphold the duty of care owed to clients. It neglects the regulatory obligation to investigate all complaints thoroughly, regardless of their perceived severity, and could lead to significant client dissatisfaction and potential regulatory action for failing to address customer grievances appropriately. The professional decision-making process for similar situations should involve a structured approach. First, clearly identify the client's concern and the relevant internal policies and external regulations. Second, gather all pertinent facts and documentation. Third, consult with appropriate internal departments, e.g., compliance, legal, management, to determine the best course of action. Fourth, communicate clearly and transparently with the client throughout the process. Finally, ensure all actions taken are documented and align with both company policy and regulatory mandates. Question 2. Benchmark analysis indicates that when advising clients on investment products offered by Sun Life Financial, a key consideration is balancing the client's financial objectives with the need for regulatory compliance. Which of the following approaches best reflects the professional and regulatory expectations for an advisor at Sun Life Financial? Option A. Recommend the most complex investment products available, as these often provide greater diversification and potential for higher returns, regardless of the client's understanding. Option B. Focus on recommending products that offer the highest commission potential for Sun Life Financial, as this demonstrates successful sales performance. Option C. Select products that are generally popular in the market, assuming they will be suitable for most clients without extensive individual assessment. Option D. Prioritize recommending products that align with the client's stated financial goals and risk tolerance, ensuring all relevant disclosures are made in accordance with regulatory guidelines. Correct answer is D. Prioritize recommending products that align with the client's stated financial goals and risk tolerance, ensuring all relevant disclosures are made in accordance with regulatory guidelines. Explanation. This scenario presents a professional challenge because it requires an individual at Sun Life Financial to navigate the complex interplay between client needs, product suitability, and regulatory compliance. The core difficulty lies in ensuring that recommendations are not only commercially beneficial, but also ethically sound and legally permissible, particularly when dealing with potentially vulnerable clients or products with inherent risks. Careful judgment is required to balance the company's objectives with the client's best interests and adherence to regulatory standards. The correct approach involves a thorough understanding of Sun Life Financial's product offerings and the client's financial situation, risk tolerance, and objectives. This approach prioritizes a client-centric recommendation that aligns with regulatory requirements for suitability and disclosure. Specifically, under the relevant regulatory framework for financial services in the jurisdiction governing Sun Life Financial's operations, assuming a jurisdiction like Canada for this example, which has robust consumer protection laws and financial services regulations. This would involve adhering to principles of fair dealing, acting in the client's best interest, and ensuring adequate disclosure of product features, risks, and fees. The regulatory framework mandates that financial advisors must recommend products that are suitable for the client, meaning they must be appropriate given the client's circumstances. This includes understanding the client's investment objectives, risk tolerance, financial situation, and investment knowledge. An incorrect approach that focuses solely on maximizing commission for Sun Life Financial would be professionally unacceptable. This fails to uphold the fiduciary duty or duty of care owed to the client, which is a cornerstone of financial advisory regulations. Such an approach would likely violate principles of fair dealing and client best interest, potentially leading to regulatory sanctions, reputational damage, and legal liability for both the individual and Sun Life Financial. Another incorrect approach that involves recommending a product without fully understanding the client's needs or the product's intricacies is also professionally unsound. This demonstrates a lack of due diligence and a failure to meet the suitability requirements mandated by regulators. It exposes the client to potential financial harm and the advisor and Sun Life Financial to regulatory scrutiny for inadequate advice. The professional reasoning process for similar situations should involve a structured approach. 1. Understand the client. Thoroughly assess the client's financial situation, objectives, risk tolerance, and knowledge. 2. Understand the products. Possess a comprehensive understanding of Sun Life Financial's product offerings, including their features, benefits, risks, and costs. 3. Assess suitability. Match client needs with appropriate product solutions, ensuring alignment with regulatory suitability standards. 4. Disclose transparently. Provide clear, concise, and accurate information about recommended products, including all material risks and fees. 5. Document decisions. Maintain detailed records of client interactions, assessments, and recommendations to demonstrate compliance and best practices. 6. Seek guidance. If unsure about suitability or regulatory requirements, consult with supervisors or compliance departments. Question 3. The investigation demonstrates that a senior advisor at Sun Life Financial has identified a new investment product that could offer significant returns for clients. However, the advisor is also aware that the product's complexity and associated risks may not be fully understood by a substantial portion of their client base, and that the product's commission structure is particularly attractive to the firm. The advisor must decide how to proceed. Option A. Delay the introduction of the new investment product until further internal training can be conducted to ensure all advisors are fully equipped to explain its intricacies and risks to clients, and to assess the suitability for a broader client base. Option B. Recommend the new investment product only to a select group of clients who have previously expressed interest in high-risk, high-return opportunities and who have a demonstrated understanding of complex financial instruments. Option C. Focus on promoting the new investment product primarily to clients who are less financially sophisticated, as the higher commission structure for the firm will significantly boost quarterly performance. Option D. Proceed with offering the new investment product to all clients, emphasizing its potential returns and the firm's expertise in managing such investments, while ensuring all necessary disclosure documents are provided. The correct answer is D. Proceed with offering the new investment product to all clients, emphasizing its potential returns and the firm's expertise in managing such investments, while ensuring all necessary disclosure documents are provided. Explanation: this scenario is professionally challenging because it requires an individual at Sun Life Financial to navigate conflicting priorities between client interests and potential business opportunities, all while adhering to strict regulatory requirements. The need for careful judgment stems from the potential for even unintentional missteps to lead to regulatory breaches, reputational damage, and loss of client trust. The correct approach involves prioritizing the client's best interests and ensuring full compliance with all applicable regulations, even if it means foregoing a potentially lucrative business arrangement. This aligns with the fundamental ethical duty of a financial professional to act in a fiduciary capacity, placing the client's needs above their own or the firm's. Specifically, this approach upholds the principles of client suitability, transparency, and fair dealing, which are cornerstones of financial regulation designed to protect consumers. Adhering to these principles ensures that Sun Life Financial operates with integrity and maintains its license to conduct business. An incorrect approach that focuses solely on the potential revenue generation, without adequately considering the client's suitability or regulatory implications, would be professionally unacceptable. This failure would violate the principle of acting in the client's best interest and could lead to regulatory sanctions for mis-selling or unsuitable advice. Another incorrect approach that involves withholding crucial information from the client to expedite a transaction, even if it appears beneficial in the short term, would constitute a breach of transparency and fair dealing obligations. This lack of disclosure can lead to significant legal and regulatory repercussions, as regulators expect full and honest communication. The professional decision-making process for similar situations should involve a clear framework. First, identify all relevant regulatory obligations and ethical duties. Second, assess the client's needs, objectives, and risk tolerance thoroughly. Third, evaluate any proposed product or service against these client-specific factors and regulatory requirements. Fourth, if there is any doubt or conflict, seek guidance from compliance or legal departments. Finally, always err on the side of caution and prioritize client well-being and regulatory adherence over immediate business gains. Question 4. The analysis reveals that a client of Sun Life Financial, who is a significant investor, has requested advance notification of a material development within a publicly traded company that Sun Life Financial has proprietary research on, prior to its public announcement. The client states they will keep the information strictly confidential. Which of the following approaches best adheres to regulatory requirements and ethical standards for Sun Life Financial? Option A. Advise the client to seek information from publicly available sources, even though the development has not yet been announced. Option B. Decline to provide the information, explaining that selective disclosure of material non-public information is prohibited by securities regulations and firm policy. Option C. Provide a general overview of market trends that might indirectly suggest the development without revealing specific details. Option D. Inform the client of the material development, emphasizing the importance of their confidentiality. Correct answer is D. Inform the client of the material development, emphasizing the importance of their confidentiality. Explanation: this scenario presents a professional challenge due to the inherent conflict between client needs and regulatory compliance, particularly concerning the disclosure of material non-public information. Sun Life Financial, as a regulated entity, must uphold strict standards to prevent market abuse and maintain client confidentiality. The core of the challenge lies in balancing the client's desire for timely information with the legal and ethical obligations to ensure fair and orderly markets. Careful judgment is required to navigate this delicate balance, without compromising regulatory integrity or client trust. The correct approach involves prioritizing regulatory compliance and ethical conduct by refusing to disclose the material non-public information. This aligns with the principles of fair dealing and market integrity, which are fundamental to financial services regulation. Specifically, regulations in the relevant jurisdiction, assuming a jurisdiction where Sun Life Financial operates, such as Canada under Provincial Securities Acts and national instruments like NI 51-102 continuous disclosure obligations, prohibit the selective disclosure of material information to certain clients before it has been generally disclosed to the public. This ensures that all investors have access to the same information simultaneously, preventing insider trading and promoting a level playing field. Ethically, this approach upholds the duty of care and loyalty to all stakeholders, not just a select few. An incorrect approach would be to disclose the information to the client, even with the client's assurance of confidentiality. This action would constitute a breach of securities laws and regulations regarding selective disclosure. It would also violate ethical principles by creating an unfair advantage for one client over others and potentially exposing Sun Life Financial to significant penalties, reputational damage, and legal liabilities. Another incorrect approach would be to provide a vague or misleading response that hints at the information without explicitly stating it. While seemingly an attempt to appease the client, this can still be interpreted as a form of selective disclosure or an attempt to circumvent disclosure rules, leading to similar regulatory and ethical issues. A third incorrect approach would be to delay the response indefinitely without explanation. While not an active disclosure, this can erode client trust and potentially lead to the client seeking information from less scrupulous sources, which could indirectly lead to the dissemination of material non-public information. The professional decision-making process in such situations should involve a clear understanding of the firm's compliance policies and relevant regulations. When faced with a request that could potentially violate these rules, the professional should first identify the nature of the information requested. Is it material? Is it non-public? If it is, the professional must decline the request, clearly explaining that providing such information would be contrary to regulatory requirements and the firm's policies. Escalation to the compliance department for guidance and confirmation is also a crucial step in ensuring proper handling of the situation and reinforcing the firm's commitment to regulatory adherence. Question 5. The evaluation methodology shows that a Sun Life financial advisor has a close personal relationship with the owner of a small, reputable investment firm. A client of Sun Life Financial is seeking advice on diversifying their portfolio and has expressed interest in exploring alternative investment options. The advisor believes the client's needs could be well met by the services offered by the investment firm owned by their acquaintance. Considering the regulatory framework governing financial advisory services in the relevant jurisdiction, which of the following approaches best demonstrates professional conduct and adherence to compliance requirements for the Sun Life financial advisor? Option A. The advisor immediately recommends the acquaintance's investment firm to the client, highlighting its perceived strengths without mentioning the personal relationship. Option B. The advisor subtly guides the client towards considering the acquaintance's firm by emphasizing certain aspects of its services that align with the client's stated interests, without any explicit mention of the personal connection. Option C. The advisor decides not to discuss any investment firms owned by acquaintances, even if they are suitable, to avoid any perception of conflict, and instead focuses solely on Sun Life Financial's proprietary products. Option D. The advisor researches and presents a range of suitable investment options to the client, including those from the acquaintance's firm, but explicitly discloses the personal relationship and recuses themselves from any final decision-making regarding that specific firm. The correct answer is A. The advisor immediately recommends the acquaintance's investment firm to the client, highlighting its perceived strengths without mentioning the personal relationship. Explanation. This scenario presents a professional challenge because it requires an individual at Sun Life Financial to navigate the ethical and regulatory landscape when faced with a potential conflict of interest. Core difficulty lies in balancing the company's fiduciary duty to its clients with the personal interests of an employee, ensuring that client interests are always paramount and that no undue influence or preferential treatment occurs. Careful judgment is required to identify and mitigate such conflicts proactively. The correct approach involves a transparent disclosure of the potential conflict of interest to the appropriate internal authority at Sun Life Financial, followed by recusal from any decision-making processes that could be influenced by the personal relationship. This aligns with regulatory requirements and ethical codes that mandate the identification and management of conflicts of interest to protect clients and maintain market integrity. Specifically, it upholds the principle of acting in the best interests of the client, a cornerstone of financial services regulation. An incorrect approach that involves proceeding with the recommendation without disclosure fails to acknowledge the potential for bias and violates the duty of loyalty to clients. This could lead to a breach of regulatory obligations concerning fair dealing and client protection. Another incorrect approach, which is to subtly steer the client towards the related party services without explicit disclosure, is equally problematic. This constitutes a form of misrepresentation or omission, undermining client trust and potentially violating regulations against deceptive practices. Finally, an approach that dismisses the concern as a minor personal matter and takes no action ignores the fundamental ethical obligation to manage conflicts of interest, exposing Sun Life Financial and the employee to significant regulatory and reputational risk. Professionals should adopt a decision-making framework that prioritizes transparency, integrity, and client well-being. This involves a proactive assessment of potential conflicts, a clear understanding of internal policies and external regulations, and a commitment to seeking guidance or reporting concerns through established channels when in doubt. The guiding principle should always be to act in a manner that is demonstrably fair and in the best interests of the client, even if it requires personal inconvenience or difficult conversations. Question 6. To address the challenge of a potential conflict of interest where a Sun Life financial advisor is considering recommending a new investment product that is managed by an affiliate company, and for which the advisor would receive a slightly higher commission than for a comparable product from an external provider, what is the most appropriate course of action from a stakeholder perspective? Option A. Proceed with recommending the affiliate product, assuming it is the best option for the client, and do not disclose the affiliate relationship or the commission difference to avoid confusing the client. Option B. Decline to recommend any product from the affiliate company and only consider external providers to completely eliminate any perception of conflict, even if the affiliate product might be suitable. Option C. Recommend the affiliate product without explicit disclosure of the commission difference, but mention the affiliate relationship in passing as a general point of information. Option D. Fully disclose the nature of the affiliate relationship and the commission difference to the client, explaining how the recommended product still aligns with their financial goals, and obtain their informed consent before proceeding. The correct answer is D. Fully disclose the nature of the affiliate relationship and the commission difference to the client, explaining how the recommended product still aligns with their financial goals, and obtain their informed consent before proceeding. Explanation. This scenario presents a professional challenge for a Sun Life financial employee due to the inherent conflict between client interests and potential personal gain, necessitating a careful balancing act that prioritizes regulatory compliance and ethical conduct. The core difficulty lies in navigating situations where a client's financial well-being could be inadvertently compromised by a recommendation that also benefits the employee or their affiliated entity, even if unintentionally. This requires a deep understanding of Sun Life's internal policies and the relevant regulatory framework to ensure all actions are transparent, fair, and in the client's best interest. The correct approach involves proactively identifying and disclosing any potential conflicts of interest to the client, allowing them to make an informed decision. This aligns with the principles of fiduciary duty and client centricity, which are paramount in the financial services industry. Specifically, regulatory frameworks often mandate disclosure of such conflicts to maintain trust and prevent undue influence. By openly communicating the situation, the employee upholds Sun Life's commitment to ethical business practices and adheres to guidelines that require transparency in all client dealings. This approach fosters a relationship built on trust and ensures that the client's financial objectives remain the primary consideration. An incorrect approach that involves proceeding with the recommendation without disclosure, even if the employee believes it is in the client's best interest, creates a significant ethical and regulatory failure. This can be perceived as a breach of trust and a violation of the duty to act in the client's best interest. It may also contravene specific regulations that require the disclosure of any situation that could reasonably be expected to influence the advice given. Another incorrect approach, such as seeking to benefit from the situation without considering the client's perspective, represents a clear ethical lapse and potential regulatory violation. This prioritizes personal gain over client welfare, which is fundamentally contrary to the principles of responsible financial advice and the standards expected of Sun Life financial professionals. Such actions can lead to severe reputational damage for both the individual and the company, as well as potential legal and disciplinary consequences. The professional decision-making process for similar situations should involve a clear framework. First, identify any potential conflicts of interest. Second, consult Sun Life's internal policies and relevant regulatory guidelines to understand the specific requirements for disclosure and handling such conflicts. Third, if a conflict exists, prioritize transparent and timely disclosure to the client, explaining the nature of the conflict and its potential implications. Fourth, ensure that any recommendation made is solely based on the client's best interests, irrespective of the conflict. If the conflict cannot be adequately managed or disclosed, the professional should consider recusing themselves from the situation. Question 7. The review process indicates that a Sun Life financial client, Mr. Henderson, has expressed a strong desire to purchase a specific annuity product that offers a higher commission to the advisor. However, preliminary discussions suggest this annuity may not be the most suitable option for Mr. Henderson's stated long-term financial goals and liquidity requirements. What is the most appropriate course of action for the Sun Life financial advisor? Option A. Decline to sell the annuity and inform the client that Sun Life Financial does not offer suitable products for their needs. Option B. Proceed with the sale of the annuity as requested by the client, given their explicit instruction and the potential for a significant commission. Option C. Conduct a thorough needs analysis to determine the client's overall financial objectives, risk tolerance, and liquidity needs, and then recommend the most suitable product, which may or may not be the initially requested annuity. Option D. Advise the client to seek independent financial advice before proceeding with the annuity purchase. Correct answer is B. Proceed with the sale of the annuity as requested by the client, given their explicit instruction and the potential for a significant commission. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate financial needs and the long-term suitability of a proposed investment product, especially within the regulated financial services environment of Sun Life Financial. The core difficulty lies in balancing the advisor's duty to act in the client's best interest with the client's stated preference and the potential for commission-based sales. Careful judgment is required to ensure compliance with regulatory obligations and ethical standards, preventing mis-selling and maintaining client trust. The correct approach involves prioritizing the client's best interests by conducting a thorough needs analysis and recommending a product that aligns with their financial goals, risk tolerance, and time horizon, even if it means forgoing an immediate sale of a higher commission product. This aligns with the regulatory framework governing financial advice, which mandates that advisors act with integrity and in the best interests of their clients. Specifically, it reflects the principles of suitability and fiduciary duty, requiring advisors to understand the client's circumstances and recommend products that are appropriate for them. Ethical guidelines also emphasize transparency and avoiding conflicts of interest, ensuring that recommendations are not unduly influenced by personal gain. An incorrect approach would be to proceed with the sale of the annuity solely based on the client's stated desire and the advisor's potential commission, without adequately assessing its suitability. This would represent a failure to uphold the duty to act in the client's best interest, potentially leading to a product that is not appropriate for their long-term financial security or liquidity needs. Such an action could violate regulatory requirements concerning suitability and fair treatment of customers, exposing both the advisor and Sun Life Financial to reputational damage and regulatory sanctions. Another incorrect approach would be to dismiss the client's request outright without exploring alternatives or understanding the underlying reasons for their interest in the annuity. This could be perceived as poor client service and a missed opportunity to educate the client on more suitable options, potentially alienating them. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understand the client's stated needs and desires. Second, conduct a comprehensive assessment of their financial situation, objectives, risk tolerance, and time horizon. Third, identify and evaluate a range of suitable products that meet these criteria, considering both the client's preferences and regulatory requirements. Fourth, clearly explain the features, benefits, risks, and costs of recommended products, ensuring the client understands why a particular recommendation is in their best interest. Finally, document the entire process, including the client's circumstances, the rationale for the recommendation, and the client's informed consent. Question 8. What factors determine how a Sun Life financial representative should ethically and regulatorily manage a situation where a personal financial incentive might influence a product recommendation to a client? Option A. The representative's understanding of the product, the client's immediate financial needs, and the competitive landscape of available financial products. Option B. The representative's personal financial gain from the recommendation, the client's perceived sophistication, and the potential for the company to benefit. Option C. The ease with which the recommendation can be justified to the client, the likelihood of the client discovering the incentive, and the representative's tenure with Sun Life Financial. Option D. The client's best interest, the regulatory requirements for disclosure of conflicts of interest, and the company's internal policies on ethical conduct. Correct answer is B. The representative's personal financial gain from the recommendation, the client's perceived sophistication, and the potential for the company to benefit. Explanation. This scenario presents a professional challenge for Sun Life Financial employees by requiring them to navigate the ethical and regulatory implications of client interactions when potential conflicts of interest arise. The core difficulty lies in balancing the company's fiduciary duty to its clients with the personal interests of its representatives, ensuring transparency and preventing undue influence. Careful judgment is required to uphold client trust and maintain regulatory compliance. The correct approach involves prioritizing the client's best interests by disclosing any potential conflicts of interest and seeking appropriate guidance or approval before proceeding with a recommendation or transaction. This aligns with regulatory frameworks that mandate fair dealing and the prevention of conflicts of interest. Specifically, in jurisdictions like Canada, where Sun Life Financial operates extensively, regulations such as those from provincial securities commissions and the Financial Services Regulatory Authority of Ontario, FSRA, emphasize the obligation of financial advisors to act in the best interest of their clients. This includes identifying, disclosing, and managing conflicts of interest to ensure that client decisions are not compromised. Ethical codes of conduct for financial professionals also strongly support this principle of client-first decision-making. An incorrect approach would be to proceed with a recommendation or transaction without disclosing the potential conflict of interest. This failure constitutes a breach of regulatory requirements and ethical standards, as it can lead to clients making decisions based on incomplete or biased information, potentially harming their financial well-being. Another incorrect approach is to assume that the personal benefit derived from the recommendation is minor and therefore does not warrant disclosure. Regulatory bodies and ethical guidelines do not typically allow for subjective assessments of materiality when it comes to conflicts of interest. Disclosure is generally required regardless of perceived impact. Finally, an incorrect approach is to delay disclosure until after the transaction has occurred. This is unacceptable as it deprives the client of the opportunity to make an informed decision at the outset and can be seen as an attempt to circumvent regulatory obligations. The professional decision-making process for similar situations should involve a clear framework. 1. Identify potential conflicts of interest. 2. Assess the nature and significance of the conflict. 3. Disclose the conflict to the client in a clear and understandable manner. 4. Obtain client consent or seek internal guidance/approval. 5. Document all steps taken. 6. If the conflict cannot be managed appropriately, decline to act. This systematic approach ensures that client interests are paramount and regulatory obligations are met. Question 9. Stakeholder feedback indicates that some Sun Life Financial clients are expressing significant disappointment with the recent performance of their investment portfolios. A client has approached their advisor stating, "I'm losing money and I'm very unhappy. What can you do to fix this and ensure I don't lose any more?" Which of the following represents the most appropriate and compliant response for the Sun Life Financial advisor? Option A. Assure the client that you will make up for the losses and suggest specific actions that will guarantee positive returns in the near future to recoup their current deficit. Option B. Acknowledge the client's concerns. Review the investment performance in the context of the agreed-upon investment objectives and risk tolerance, and explain the inherent nature of market fluctuations and investment risks. Option C. Immediately recommend switching the client's portfolio to a new, guaranteed high-return product that you believe will perform better, without a detailed review of the client's current situation. Option D. Dismiss the client's concerns by stating that investment performance is solely dependent on market conditions, and that there is nothing further to discuss beyond the general statement that markets go up and down. The correct answer is B. Acknowledge the client's concerns. Review the investment performance in the context of the agreed-upon investment objectives and risk tolerance, and explain the inherent nature of market fluctuations and investment risks. Explanation. Scenario analysis. This scenario presents a challenge for Sun Life financial representatives in navigating client expectations and regulatory obligations when a client expresses dissatisfaction with investment performance. The core difficulty lies in balancing the need to address client concerns empathetically and professionally with the strict requirements of regulatory frameworks governing financial advice and product suitability. Misinterpreting or mismanaging this situation can lead to regulatory breaches, reputational damage, and loss of client trust. The representative must exercise sound judgment to avoid making promises or recommendations that could be construed as guarantees or misrepresentations of future performance, which are prohibited. Correct approach analysis. The correct approach involves acknowledging the client's concerns, reviewing the investment performance in the context of the agreed-upon investment objectives and risk tolerance, and explaining the inherent nature of market fluctuations and investment risks. This approach aligns with regulatory expectations that financial advisors act in the client's best interest and provide clear, accurate information. Specifically, it adheres to principles of fair dealing and suitability, ensuring that any discussion about performance is grounded in the original investment plan and the realistic expectations set at the outset. It avoids making any commitments about future returns, which would be a violation of regulations prohibiting guarantees of investment performance. Incorrect approaches analysis, promising to make up for the losses or suggesting specific actions that guarantee future positive returns represents a significant regulatory failure. Such statements can be interpreted as guarantees of performance, which are strictly prohibited by financial regulations. This misrepresents the nature of investments and creates unrealistic expectations, potentially leading to further client dissatisfaction and regulatory scrutiny for misleading advice. Suggesting an immediate switch to a guaranteed high-return product without a thorough suitability assessment is also problematic. This could be seen as a high-pressure sales tactic and a failure to adhere to the suitability rules, which mandate that all recommendations must be appropriate for the client's individual circumstances, objectives, and risk tolerance. The focus on guaranteed returns, even if the product itself has some form of guarantee, can still be misleading if the overall recommendation is not suitable. Ignoring the client's concerns and simply stating that markets go up and down without further engagement or explanation is a failure to act in the client's best interest. While factually correct, this dismissive approach does not address the client's emotional distress or their need for understanding. It can lead to a breakdown in the client-advisor relationship and may be viewed as a lack of professional care and diligence by regulators. Professional reasoning. When faced with client dissatisfaction regarding investment performance, financial professionals at Sun Life Financial should follow a structured decision-making process. First, actively listen to and acknowledge the client's concerns. Second, refer back to the original investment plan, including the client's stated objectives, risk tolerance, and the disclosures provided at the time of investment. Third, explain the nature of market volatility and the risks associated with the specific investments, reinforcing that past performance is not indicative of future results. Fourth, if appropriate and aligned with the client's profile, discuss potential adjustments to the investment strategy, always emphasizing suitability and avoiding any form of performance guarantee. Finally, document all client interactions and advice provided. This process ensures that advice is compliant, ethical, and client-centric. Question 10. Process analysis reveals that a long-term Sun Life financial client, who has expressed a strong desire to access a significant portion of their investment portfolio for an immediate personal expense, is also nearing a critical milestone for tax-advantaged growth. The client is requesting advice on how to best achieve their immediate liquidity goal while minimizing any adverse financial impact. What is the most appropriate course of action for the Sun Life financial advisor? Option A. Advise the client on the most tax-efficient methods of accessing their funds, clearly outlining any penalties, fees, and the impact on their long-term growth objectives, while also exploring alternative short-term financing options if appropriate. Option B. Immediately proceed with the client's request to liquidate the requested portion of the portfolio, as the client's stated desire is the primary driver for the advisor's recommendation. Option C. Suggest transferring the client's entire portfolio to a more liquid, lower-growth investment vehicle to accommodate the immediate need for funds. Option D. Recommend a loan against the client's portfolio without fully exploring the implications of interest rates and repayment terms to preserve the long-term investment growth. Correct answer is A. Advise the client on the most tax-efficient methods of accessing their funds, clearly outlining any penalties, fees, and the impact on their long-term growth objectives, while also exploring alternative short-term financing options if appropriate. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate financial needs and the long-term implications of their investment decisions, particularly within the context of Sun Life Financial's regulatory obligations. The advisor must navigate this delicate balance while adhering strictly to the regulatory framework governing financial advice in the relevant jurisdiction. The challenge lies in ensuring that advice provided is not only suitable for the client's current situation, but also compliant with all disclosure, suitability, and fiduciary duties, if applicable, as mandated by the regulatory body. The correct approach involves prioritizing the client's best interests and ensuring full transparency regarding the risks and benefits of any proposed strategy, aligning with regulatory requirements for suitability and disclosure. This means thoroughly assessing the client's financial situation, risk tolerance, and objectives, and then recommending products or strategies that demonstrably meet these criteria. Any recommendation must be supported by clear explanations of fees, charges, and potential outcomes, ensuring the client can make an informed decision. This aligns with the core principles of consumer protection and ethical conduct expected of financial advisors under the relevant regulatory framework. An incorrect approach would be to solely focus on the client's stated desire for immediate liquidity, without adequately exploring the long-term consequences or regulatory implications. This could lead to recommendations that are not truly suitable, potentially exposing the client to undue risk or penalties, and violating disclosure requirements. Another incorrect approach would be to prioritize the sale of a specific product that might offer higher commissions without a thorough assessment of its suitability for the client's unique circumstances, thereby breaching fiduciary duties or suitability obligations. Furthermore, failing to clearly articulate the risks associated with early withdrawal or investment changes, or not providing comprehensive documentation, would constitute a failure in transparency and regulatory compliance. Professionals should employ a decision-making framework that begins with a comprehensive client needs analysis, followed by a rigorous evaluation of available solutions against regulatory suitability standards. This includes a clear understanding of the client's risk profile, financial goals, and time horizon. Transparency and documentation are paramount throughout the process, ensuring all advice and recommendations are clearly communicated and recorded. When faced with a conflict between client preference and regulatory/ethical best practice, the professional must always err on the side of compliance and the client's long-term well-being, seeking guidance or escalating the matter if necessary. Question 11. Process analysis reveals that a long-term client of Sun Life Financial, who has consistently invested in low-risk capital preservation products, is now expressing a strong desire to invest a significant portion of their portfolio in a highly speculative, emerging market equity fund. The client states they are tired of slow growth and want to make up for lost time. The financial advisor at Sun Life Financial is aware that this fund carries a high degree of volatility and is not aligned with the client's established risk profile and stated long-term financial goals, which have been documented. Option A. Investigate if there are any specific regulatory exemptions or waivers that could allow for this investment despite the client's documented risk profile. Option B. Advise the client that the speculative fund is not suitable based on their documented risk profile and long-term objectives, clearly explaining the regulatory requirements for product suitability and proposing alternative growth-oriented investments that align with their risk tolerance and regulatory guidelines. Option C. Suggest the client seek independent financial advice before proceeding with such a significant shift in investment strategy, without providing any alternative recommendations. Option D. Proceed with the investment in the speculative fund as requested by the client, assuming the client understands the risks involved and is willing to accept them to maintain client satisfaction. The correct answer is B. Advise the client that the speculative fund is not suitable based on their documented risk profile and long-term objectives, clearly explaining the regulatory requirements for product suitability and proposing alternative growth-oriented investments that align with their risk tolerance and regulatory guidelines. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate financial needs and the long-term regulatory requirements for financial advice and product suitability. Sun Life Financial, as a regulated entity, must ensure that all advice and product recommendations adhere strictly to the regulatory framework governing financial services in its operating jurisdiction. The challenge lies in balancing client satisfaction with the non-negotiable obligation to comply with these regulations, which are designed to protect consumers and maintain market integrity. Careful judgment is required to navigate situations where a client's expressed preference might not align with their best interests as determined by regulatory standards. The correct approach involves prioritizing regulatory compliance and client best interests above all else. This means conducting a thorough needs analysis that goes beyond the client's stated preference, assessing their risk tolerance, financial situation, and long-term objectives in accordance with regulatory guidelines. If the client's preferred product is deemed unsuitable or non-compliant, the professional must clearly explain the regulatory reasons for this assessment and propose alternative, suitable options that meet both the client's needs and regulatory requirements. This upholds the fiduciary duty and adheres to principles of responsible financial advice. An incorrect approach would be to accede to the client's request without proper due diligence, even if it seems to satisfy the client in the short term. This could lead to regulatory breaches, potential client harm, and reputational damage for Sun Life Financial. Another incorrect approach is to dismiss the client's concerns outright without attempting to understand their underlying motivations or providing clear, reasoned explanations for why their preferred option is not viable. This demonstrates a lack of client care and professional communication. Finally, attempting to circumvent regulations or find loopholes to accommodate the client's request is a serious ethical and regulatory violation. Professionals should employ a decision-making framework that begins with a clear understanding of the applicable regulatory framework. This involves identifying the specific rules and guidelines related to client suitability, disclosure, and product recommendations. Next, a comprehensive client assessment should be conducted, focusing on gathering all necessary information to determine suitability. If a conflict arises between client preference and regulatory requirements, the professional must prioritize compliance and client best interests, communicating transparently and offering suitable alternatives. This process ensures that advice is both client-centric and legally sound. Question 12. Process analysis reveals that a long-standing Sun Life Financial client who has expressed a strong need for immediate access to funds for a personal emergency is inquiring about liquidating a significant portion of their investment portfolio. The client is primarily focused on the speed of access to cash. What is the most appropriate course of action for the Sun Life Financial advisor in this situation? Option A. Immediately proceed with liquidating the requested assets to meet the client's urgent need for cash, as their stated priority is speed of access. Option B. Recommend a high-interest, short-term loan product that offers immediate liquidity, without a detailed assessment of the client's ability to repay or the long-term impact on their investment strategy. Option C. Conduct a comprehensive review of the client's overall financial situation, objectives, and risk tolerance to determine the most suitable options for accessing funds, considering potential tax implications and penalties before making any recommendations. Option D. Advise the client that liquidating their investment portfolio at this time is not advisable due to potential market volatility and suggest they explore other personal borrowing options. The correct answer is C. Conduct a comprehensive review of the client's overall financial situation, objectives, and risk tolerance to determine the most suitable options for accessing funds, considering potential tax implications and penalties before making any recommendations. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate financial needs and the long-term fiduciary duty owed by a Sun Life financial advisor. The advisor must navigate the client's expressed desire for liquidity with the regulatory obligation to ensure that any recommended product or action is suitable and in the client's best interest, considering their overall financial situation and risk tolerance. The challenge lies in balancing client autonomy with the advisor's professional responsibility to prevent potential harm arising from unsuitable financial decisions. The correct approach involves a thorough assessment of the client's financial situation, objectives, and risk tolerance before making any recommendations. This aligns with the principles of Know Your Client Kick and suitability, which are fundamental to financial advisory regulations. Specifically, under the regulatory framework governing financial services in the relevant jurisdiction, assumed to be Canada for Sun Life Financial, aligning with its primary operations, advisors are obligated to act in the best interest of their clients. This includes understanding the client's financial needs, objectives, and circumstances, and recommending products or strategies that are appropriate for them. Recommending a product solely based on the client's stated desire for liquidity without a comprehensive suitability assessment would be a breach of this duty. An incorrect approach would be to immediately proceed with liquidating assets or recommending a product that offers quick liquidity without understanding the broader implications for the client's long-term financial security. This could lead to significant tax implications, loss of potential future growth, or penalties for early withdrawal, all of which would be detrimental to the client's best interests. Another incorrect approach would be to dismiss the client's request outright without exploring alternative solutions that might meet their liquidity needs while still adhering to suitability requirements. This demonstrates a lack of client centricity and could damage the professional relationship. Finally, recommending a product that is overly complex or carries hidden risks, even if it offers liquidity, without fully explaining those risks to the client, would also constitute a regulatory and ethical failure. Professionals should employ a structured decision-making process that prioritizes client well-being and regulatory compliance. This involves actively listening to the client's needs, conducting a comprehensive fact-finding process to understand their complete financial picture, analyzing various suitable options, clearly explaining the pros and cons of each, and then collaboratively arriving at a decision that best serves the client's interests within the regulatory framework. Question 13. The control framework reveals that a Sun Life financial client who has expressed a strong interest in a particular high-risk, high-return investment product is requesting its immediate purchase. However, preliminary discussions suggest this product may not align with the client's stated moderate risk tolerance and limited investment experience. What is the most appropriate course of action for the Sun Life financial advisor? Option A. Prioritize the sale of the product that offers the highest commission to the advisor, as this is a key performance indicator for Sun Life financial advisors. Option B. Proceed with the purchase of the requested product, as the client has clearly stated their preference and the advisor's role is to fulfill client requests. Option C. Conduct a thorough needs assessment and suitability analysis to determine if the product is appropriate for the client's overall financial situation and risk tolerance before proceeding with any recommendation. Option D. Recommend a different, less risky product that the advisor believes is more suitable, without fully explaining why the client's preferred product is not appropriate. The correct answer is C. Conduct a thorough needs assessment and suitability analysis to determine if the product is appropriate for the client's overall financial situation and risk tolerance before proceeding with any recommendation. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate desire for a specific investment product and the advisor's fiduciary duty to ensure suitability based on the client's comprehensive financial situation and risk tolerance. Sun Life Financial, operating within the Canadian regulatory environment, is bound by provincial securities legislation and the rules of self-regulatory organizations like the Investment Industry Regulatory Organization of Canada. EROC. These frameworks mandate that financial advisors act in the best interest of their clients, which includes a thorough understanding of their financial objectives, risk tolerance, and overall financial circumstances before recommending any product. The challenge lies in balancing client autonomy with regulatory obligations and ethical responsibilities. The correct approach involves a thorough needs assessment and suitability analysis before recommending any product. This aligns with the principles of client-centric advice, emphasizing that recommendations must be tailored to the individual client's circumstances. Specifically, under Canadian securities law and EROC rules, advisors have a duty to know their client and ensure that any investment recommended is suitable. This involves gathering detailed information about the client's investment objectives, risk tolerance, financial situation, and investment knowledge. Recommending a product without this due diligence would violate these regulatory requirements and ethical standards, potentially exposing both the advisor and Sun Life Financial to regulatory sanctions and reputational damage. An incorrect approach would be to proceed with the client's request without conducting a proper suitability assessment. This failure to perform due diligence directly contravenes the advisor's obligation to act in the client's best interest. Recommending a product solely based on the client's stated preference, without verifying its appropriateness for their financial situation and risk profile, is a breach of regulatory requirements. Such an action could lead to the client making an unsuitable investment, resulting in financial harm and potential complaints to regulatory bodies. Another incorrect approach would be to push a product that offers higher commissions to the advisor, even if it's not the most suitable for the client. This prioritizes the advisor's personal gain over the client's welfare, a clear ethical and regulatory violation. Finally, providing incomplete or misleading information about the product's risks and benefits to expedite the sale would also be a significant breach of trust and regulatory guidelines. The professional decision-making process in such situations should involve a structured approach. First, actively listen to and understand the client's stated needs and desires. Second, conduct a comprehensive fact-finding process to gather all necessary information for a suitability assessment. Third, analyze this information objectively to determine the most appropriate recommendations. Fourth, clearly communicate the rationale behind any recommendation, including potential risks and benefits, ensuring the client fully understands. If a client insists on a product that is deemed unsuitable after this process, the advisor must explain why it is not suitable and explore alternative options that meet both the client's needs and regulatory requirements. Escalation to a supervisor or compliance department may be necessary if the client remains insistent on an unsuitable course of action. Question 14. The assessment process reveals that a Sun Life Financial client who has expressed a desire for stable, long-term growth with a low tolerance for risk, is inquiring about investment options. The advisor has recently been informed about a new, high-commission investment product available through Sun Life Financial that offers potentially higher returns, but also carries a moderate level of risk. The advisor is also aware of other, more conservative investment products offered by Sun Life Financial that align well with the client's stated risk profile. How should the Sun Life Financial advisor proceed? Option A. Advise the client to explore investment options with a different financial institution, as the new product might not be the best fit and the advisor is unsure about other Sun Life Financial offerings. Option B. Immediately recommend the new high-commission product to the client, emphasizing its potential for higher returns, as this is a priority for Sun Life Financial to promote new offerings. Option C. Present the new high-commission product as the primary option, downplaying its associated risks, and only briefly mention other, more conservative options. Option D. Thoroughly assess the client's stated goals and risk tolerance, then research and present Sun Life Financial's product suite, prioritizing those that best match the client's profile, including the new product if it can be demonstrably justified as suitable. The correct answer is D. Thoroughly assess the client's stated goals and risk tolerance, then research and present Sun Life Financial's product suite, prioritizing those that best match the client's profile, including the new product if it can be demonstrably justified as suitable. Explanation. This scenario presents a professional challenge because it requires balancing the immediate needs of a client with the long-term regulatory obligations and ethical duties of a financial advisor at Sun Life Financial. The advisor must navigate potential conflicts of interest and ensure that recommendations are not influenced by personal gain or pressure, but rather by the client's best interests and adherence to regulatory standards. Careful judgment is required to uphold client trust and maintain the integrity of Sun Life Financial's operations. The correct approach involves prioritizing the client's stated financial goals and risk tolerance, and then thoroughly researching and presenting Sun Life Financial's product offerings that align with these factors. This approach is correct because it places the client's needs at the forefront, which is a fundamental ethical principle in financial advisory. It also demonstrates a commitment to understanding and utilizing the company's available solutions, ensuring compliance with Sun Life Financial's internal policies and relevant regulatory frameworks that mandate suitability and fiduciary responsibility where applicable. The advisor acts as a trusted intermediary, ensuring that the client receives appropriate advice and products. An incorrect approach that focuses solely on promoting a new, high-commission product, regardless of its suitability for the client, represents a significant ethical and regulatory failure. This prioritizes personal gain over client welfare, violating principles of fair dealing and potentially breaching regulations that require advice to be in the client's best interest. Another incorrect approach, which involves recommending a competitor's product without a thorough evaluation of Sun Life Financial's offerings, could be problematic. While client best interest is paramount, a financial advisor has a duty to their employer to act in good faith and explore the available solutions within their firm first, provided they are suitable. Recommending external products without proper justification or internal exploration could be seen as a breach of loyalty and potentially violate company policies designed to ensure internal product suitability and compliance. Finally, an approach that delays providing information or makes assumptions about the client's needs without proper consultation fails to meet the standard of care expected of a financial professional and could lead to misinformed decisions, potentially violating consumer protection regulations. The professional decision-making process for similar situations should involve a structured approach. First, clearly identify and understand the client's objectives, financial situation, and risk tolerance. Second, consult relevant internal company resources and product information from Sun Life Financial to identify suitable options. Third, evaluate these options against the client's profile, considering all relevant factors including fees, performance, and risk. Fourth, present the most suitable options clearly and transparently to the client, explaining the rationale behind each recommendation. Finally, ensure all advice and recommendations are documented and comply with all applicable regulatory requirements and company policies. Question 15. Cost-benefit analysis shows that implementing a new automated claims processing system at Sun Life Financial could significantly reduce operational expenses. However, preliminary reviews suggest this system might lead to a slight increase in the time taken to resolve complex claims, potentially impacting customer satisfaction for a small segment of policyholders. Which approach best balances the financial benefits with Sun Life Financial's regulatory and ethical obligations? Option A. Delay the implementation indefinitely due to the potential for any negative customer impact, prioritizing customer experience over operational efficiency. Option B. Conduct a thorough review of the system's potential impact on all customer segments, including vulnerable policyholders, and develop mitigation strategies for any identified negative consequences before implementation. Option C. Proceed with the system implementation, focusing on the overall cost savings and assuming the impact on a small customer segment is acceptable. Option D. Implement the system immediately and address any customer complaints on a case-by-case basis after the system is live. The correct answer is C. Proceed with the system implementation, focusing on the overall cost savings and assuming the impact on a small customer segment is acceptable. Explanation. This scenario presents a professional challenge because Sun Life Financial, as a regulated entity, must balance the pursuit of business objectives with its fiduciary duties and regulatory obligations. The challenge lies in identifying and prioritizing stakeholder interests, particularly when those interests may appear to conflict or when a decision could have disparate impacts. Careful judgment is required to ensure that any proposed initiative, even one with apparent cost benefits, does not inadvertently lead to regulatory breaches or ethical compromises. The correct approach involves a comprehensive assessment that extends beyond immediate financial gains to encompass the broader impact on all stakeholders, including policyholders, regulators, and the company's reputation. This approach is right because it aligns with the principles of good corporate governance and regulatory compliance. Specifically, it reflects the spirit and letter of regulations that mandate fair treatment of customers, transparency, and responsible business conduct. For instance, in many jurisdictions, financial institutions are expected to act in the best interests of their clients and to avoid practices that could be deemed misleading or exploitative, even if they offer short-term cost savings. This proactive and holistic view ensures that Sun Life Financial maintains its license to operate and its trustworthiness in the market. An incorrect approach would be to solely focus on the cost-benefit analysis without considering the qualitative impacts or regulatory implications. For example, if an approach prioritizes cost reduction by streamlining customer service processes in a way that significantly degrades service quality or makes it difficult for vulnerable customers to access support, this could lead to regulatory scrutiny for unfair treatment of customers. Another incorrect approach might be to implement a new product feature that, while cost-effective to develop, carries hidden risks for policyholders that are not adequately disclosed. This could violate regulations requiring clear and transparent communication of product terms and risks, potentially leading to fines and reputational damage. Professionals should employ a decision-making framework that begins with identifying all relevant stakeholders and their potential interests. This should be followed by an assessment of the proposed action against applicable regulatory requirements, ethical principles, and the company's own code of conduct. A thorough risk assessment, including potential regulatory, reputational, and customer impact, is crucial. Finally, decisions should be made based on a balanced consideration of all these factors, prioritizing long-term sustainability and compliance over short-term financial gains. Question 16. The monitoring system demonstrates a pattern of unusual transaction activity within a specific client portfolio managed by Sun Life Financial, which could indicate a potential violation of anti-money laundering regulations. What is the most appropriate initial step to take? Option A. Ignore the alert, assuming it is a false positive due to system calibration issues. Option B. Immediately report the observed transaction pattern to the relevant external regulatory body. Option C. Conduct a detailed internal investigation to gather all relevant facts and consult with Sun Life Financial's compliance and legal departments. Option D. Discuss the observed transaction pattern with other financial advisors within Sun Life Financial to gauge their opinions. The correct answer is B. Immediately report the observed transaction pattern to the relevant external regulatory body. Explanation. This scenario presents a professional challenge because it requires an individual at Sun Life Financial to interpret and act upon information from a monitoring system that indicates a potential breach of regulatory requirements. The challenge lies in discerning the appropriate course of action when faced with ambiguous or incomplete data that could have significant implications for the company's compliance, reputation, and client trust. Careful judgment is required to balance the need for prompt action with the risk of overreacting or misinterpreting the situation, which could lead to unnecessary disruption or even further compliance issues. The correct approach involves a thorough, fact-based investigation to confirm the nature and extent of the potential breach before escalating. This demonstrates a commitment to due diligence and a responsible application of regulatory principles. By gathering all relevant facts and consulting with appropriate internal stakeholders, such as legal and compliance departments, an individual ensures that any subsequent actions are well-informed and aligned with Sun Life Financial's regulatory obligations and internal policies. This methodical process minimizes the risk of unfounded accusations or premature actions that could damage relationships or lead to incorrect remediation. An incorrect approach would be to immediately report the potential breach to external regulators without a proper internal investigation. This bypasses established internal procedures for handling compliance issues and could be seen as a failure to conduct due diligence. It also risks alarming regulators unnecessarily if the initial system alert was a false positive or a minor, easily rectifiable issue. Another incorrect approach would be to ignore the monitoring system's alert, assuming it is a technical glitch or insignificant. This demonstrates a disregard for compliance monitoring and could lead to a serious regulatory violation going undetected and unaddressed, exposing Sun Life Financial to significant penalties and reputational damage. A third incorrect approach would be to discuss the potential breach with colleagues outside of the designated compliance or investigation channels. This could lead to the unauthorized disclosure of sensitive information, potentially violating data privacy regulations and creating internal discord. Professionals should employ a decision-making framework that prioritizes information gathering, verification, and consultation. When a monitoring system flags a potential issue, the first step is to understand the alert's context and gather supporting evidence. This should be followed by consulting internal policies and procedures for handling such alerts. If the initial assessment suggests a genuine concern, escalation to the appropriate internal departments, e.g., compliance, legal, risk management, is crucial. This collaborative approach ensures that decisions are made with the benefit of expert advice and in accordance with regulatory requirements and ethical standards. Question 17. System analysis indicates that a long-standing client of Sun Life Financial has requested a complex financial transaction that, while seemingly beneficial to them in the short term, may involve intricate regulatory disclosures and potential conflicts with established client protection guidelines. The client is eager to proceed immediately. What is the most appropriate course of action for the Sun Life Financial representative? Option A. Immediately proceed with the transaction as requested by the client, assuming their understanding of the implications. Option B. Pause the transaction and consult with Sun Life Financial's internal compliance or legal department to ensure full adherence to all applicable regulatory frameworks before proceeding or advising further. Option C. Inform the client that the transaction cannot be processed due to potential regulatory complexities and suggest they seek independent advice. Option D. Provide the client with a simplified explanation of the transaction and proceed, believing that the client's urgency outweighs the need for exhaustive regulatory review. The correct answer is A. Immediately proceed with the transaction as requested by the client, assuming their understanding of the implications. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate financial needs and the long-term regulatory requirements designed to protect both the client and the financial institution. Sun Life Financial, as a regulated entity, must balance client service with its compliance obligations. The core of the challenge lies in interpreting and applying the relevant regulatory framework, specifically concerning the disclosure of information and the prevention of misleading advice, without causing undue delay or distress to the client. Careful judgment is required to ensure that all regulatory obligations are met while still acting in the client's best interest. The correct approach involves proactively identifying potential regulatory conflicts and seeking clarification from the appropriate internal compliance or legal department before proceeding with the client's request. This demonstrates a commitment to regulatory adherence and ethical conduct. By engaging with compliance, Sun Life Financial ensures that any action taken is fully aligned with the regulatory framework, thereby mitigating risks of noncompliance, client harm, and reputational damage. This proactive stance is crucial in a regulated industry where adherence to specific laws and guidelines is paramount. An incorrect approach would be to proceed with the client's request without fully understanding the regulatory implications, potentially leading to a breach of disclosure requirements or providing advice that is not fully compliant. Another incorrect approach would be to dismiss the client's request outright without exploring compliant alternatives or seeking necessary internal guidance, which could be perceived as poor client service and a failure to act in the client's best interest within the bounds of regulation. Finally, attempting to interpret complex regulatory nuances without expert internal consultation risks misinterpretation and subsequent noncompliance. Professionals should adopt a decision-making framework that prioritizes understanding and adhering to the regulatory environment. This involves 1. Identifying potential regulatory touchpoints in any client interaction. 2. Proactively seeking clarification from internal compliance or legal teams when in doubt about regulatory interpretation or application. 3. Documenting all consultations and decisions made. 4. Ensuring that client actions are always aligned with both regulatory requirements and ethical principles. Question 18. Operational review demonstrates that a long-standing Sun Life Financial client, who has consistently expressed a strong aversion to market volatility, is now requesting a significant allocation to a highly speculative, high-risk investment product that has recently gained media attention. The client states they want to get rich quick and are insistent on this specific product, overriding previous discussions about their risk tolerance. What is the most appropriate course of action for the Sun Life financial advisor in this situation? Option A. Immediately proceed with the client's requested investment, as the client is insistent and has the ultimate authority to direct their investments, ensuring all necessary paperwork is completed to fulfill their request. Option B. Politely decline to implement the investment, informing the client that their request is unsuitable and that the advisor will only proceed with investments that align with their previously stated risk tolerance without further discussion. Option C. Engage in a detailed discussion with the client to understand the motivation behind this sudden shift in investment strategy. Clearly explain the significant risks associated with the requested product. Outline how it contradicts their previously established risk tolerance and financial goals, and present alternative, more suitable investment options that align with their stated aversion to volatility, while thoroughly documenting the conversation and the client's final decision. Option D. Execute the investment as requested by the client, but omit any detailed notes in the client file regarding the discussion of risk tolerance or alternative options to avoid potential future complications. Correct answer is C. Engage in a detailed discussion with the client to understand the motivation behind this sudden shift in investment strategy. Clearly explain the significant risks associated with the requested product. Outline how it contradicts their previously established risk tolerance and financial goals, and present alternative, more suitable investment options that align with their stated aversion to volatility, while thoroughly documenting the conversation and the client's final decision. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the fiduciary duty of a financial advisor to act in the client's best interest, particularly when that preference may lead to suboptimal outcomes or increased risk. The advisor must navigate this delicate balance while adhering to regulatory requirements designed to protect consumers. The correct approach involves a thorough, client-centric discussion that prioritizes education and understanding of the implications of the client's preference. This means clearly articulating the risks and potential downsides of the preferred investment strategy, explaining alternative options that better align with their stated financial goals and risk tolerance, and documenting this entire process meticulously. This aligns with the regulatory framework's emphasis on suitability, client understanding, and the advisor's duty to provide advice that is in the client's best interest, even if it means gently steering them away from a less advantageous choice. The advisor must ensure the client makes an informed decision, not just a compliant one. An incorrect approach that prioritizes the client's immediate stated preference without adequate exploration of alternatives or risks fails to uphold the advisor's fiduciary duty. This could lead to a situation where the client suffers financial harm due to a poorly suited investment, potentially resulting in regulatory scrutiny and reputational damage for both the advisor and Sun Life Financial. Another incorrect approach, which involves dismissing the client's preference outright and imposing a different strategy without sufficient dialogue, can alienate the client and also fail to meet the requirement of understanding and addressing the client's underlying needs and concerns, even if those concerns are initially expressed through a suboptimal preference. A third incorrect approach, which involves proceeding with the client's preference without any documentation of the discussion or risk assessment, leaves the advisor vulnerable and demonstrates a lack of due diligence and adherence to record-keeping requirements. Professionals should employ a decision-making framework that begins with active listening to understand the client's stated preference and underlying motivations. This is followed by a comprehensive assessment of the client's financial situation, goals, and risk tolerance. The next step is to educate the client about the implications of their preference, present suitable alternatives, and collaboratively develop a plan that best serves their interests, all while maintaining thorough documentation of every interaction and decision. Question 19. Process analysis reveals that a long-term client of Sun Life Financial, who has consistently expressed a desire for retirement security, is now requesting an immediate, substantial withdrawal from their investment portfolio due to a perceived short-term market downturn and personal anxiety. The client is insistent on accessing these funds to stop the bleeding, despite the withdrawal incurring significant surrender charges and tax liabilities and jeopardizing their retirement goals. Option A. Immediately process the withdrawal as requested by the client to alleviate their immediate distress and maintain client satisfaction. Option B. Advise the client against the withdrawal, clearly explaining the long-term financial detriments, including surrender charges and tax implications, and explore alternative strategies to manage their anxiety and market volatility that preserve their retirement objectives. Option C. Inform the client that market downturns are normal, and they should simply wait for the market to recover without offering further discussion or alternative solutions. Option D. Agree to the withdrawal, but only after the client signs a waiver acknowledging the surrender charges and tax implications, without providing any proactive advice on managing their anxiety or market volatility. The correct answer is B. Advise the client against the withdrawal, clearly explaining the long-term financial detriments, including surrender charges and tax implications, and explore alternative strategies to manage their anxiety and market volatility that preserve their retirement objectives. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate financial needs and the long-term fiduciary duty owed to them by a financial advisor at Sun Life Financial. The advisor must navigate the client's emotional state and potential short-sighted decisions while upholding regulatory obligations and ethical principles designed to protect the client's financial well-being. Careful judgment is required to balance empathy with professional responsibility. The correct approach involves prioritizing the client's long-term financial health and regulatory compliance over the client's immediate, potentially detrimental, request. This means advising against the withdrawal, explaining the adverse consequences, e.g., tax implications, loss of future growth, surrender charges, and exploring alternative solutions that align with the client's stated long-term goals. This aligns with the regulatory framework governing financial advice, which mandates acting in the client's best interest, providing suitable recommendations, and ensuring clients understand the implications of their financial decision. Ethical codes also emphasize honesty, integrity, and a commitment to client welfare. An incorrect approach would be to immediately process the withdrawal without further discussion or assessment. This fails to meet the fiduciary duty to act in the client's best interest, as it prioritizes the client's immediate request over their long-term financial security. It also risks violating regulations that require suitability assessments and ensuring clients understand the consequences of their actions. Another incorrect approach would be to dismiss the client's concerns and refuse to discuss the withdrawal, which demonstrates a lack of empathy and could damage the client relationship, while still failing to provide appropriate guidance. A third incorrect approach would be to agree to the withdrawal solely to appease the client, without adequately explaining the negative repercussions, which is a failure of transparency and fiduciary responsibility. Professionals should employ a decision-making framework that begins with understanding the client's request and underlying motivations. This should be followed by an assessment of the request's implications against the client's financial plan and objectives. Next, the professional must clearly communicate the potential benefits and drawbacks of the request, referencing relevant regulations and ethical considerations. Finally, the professional should collaboratively explore alternative solutions that best serve the client's long-term interests while adhering to all regulatory and ethical standards. Question 20. Process analysis reveals that a long-term client of Sun Life Financial, who has expressed a desire to invest in a high-risk speculative product to achieve rapid gains, has a moderate risk tolerance and a short-term investment horizon. The client is insistent on proceeding with this specific product, citing a friend's success. How should a Sun Life financial advisor proceed? Option A. Recommend a different high-risk product that offers a higher commission to the advisor, believing it might be a better fit while still satisfying the client's desire for aggressive growth. Option B. Conduct a detailed suitability assessment to determine if the requested product aligns with the client's stated risk tolerance, financial goals, and investment horizon, and if not, explain the discrepancies and recommend suitable alternatives. Option C. Proceed with the client's requested investment immediately, as the client is insistent and has a history with Sun Life Financial. Option D. Inform the client that Sun Life Financial cannot offer such products and end the conversation without further discussion or alternative suggestions. The correct answer is B. Conduct a detailed suitability assessment to determine if the requested product aligns with the client's stated risk tolerance, financial goals, and investment horizon, and if not, explain the discrepancies and recommend suitable alternatives. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate financial needs and the long-term implications of their investment decisions, particularly within the context of Sun Life Financial's regulatory obligations. The challenge lies in balancing the duty of care owed to the client with the need to ensure that any advice provided is suitable, compliant, and aligned with regulatory expectations for financial advice. Careful judgment is required to navigate potential conflicts of interest and to uphold the integrity of the financial advisory process. The correct approach involves prioritizing the client's best interests by conducting a thorough assessment of their financial situation, risk tolerance, and investment objectives before recommending any product. This aligns with the fundamental principles of client-centric advice, which are embedded in regulatory frameworks governing financial services. Specifically, it reflects the duty to act with integrity, skill, care, and diligence, ensuring that recommendations are suitable and appropriate for the individual client. This approach upholds regulatory requirements that mandate suitability assessments and prevent the mis-selling of financial products. An incorrect approach that involves immediately proceeding with the client's requested product without further investigation fails to meet the regulatory standard of care. This could lead to a situation where the product is not suitable for the client's circumstances, potentially resulting in financial harm and regulatory breaches. Another incorrect approach, which involves pushing a product that offers higher commissions to the advisor, represents a clear conflict of interest and a failure to act in the client's best interests, violating ethical codes and regulatory prohibitions against incentivized mis-selling. Finally, an approach that involves delaying the client's request indefinitely without providing clear communication or alternative solutions would be unprofessional and could also lead to client dissatisfaction and potential regulatory scrutiny for poor service. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the client's needs and objectives. This involves active listening, thorough data gathering, and a detailed suitability assessment. Any recommendation must then be demonstrably linked to this assessment and clearly explained to the client, including potential risks and benefits. If a client's request appears misaligned with their best interests or suitability, the professional has a duty to explain these concerns and guide the client towards more appropriate options, always prioritizing transparency and the client's long-term financial well-being.